We're going to have a question and answer period right now, and I'm going to go ahead and start it off with the first question because I'd like to address a question to one of the analysts that you haven't heard from yet, Maclovio Pina, who covers our financial sectors for us. And Maclovio, I'd like you to, if you could, tell us about what makes the Latin American banking opportunity so attractive right now. And why don't you begin by introducing yourself and telling us a little bit about your background?
Sure. I am Maclovio Pina. I work at INCA. I cover the financial companies. I cover airports. I cover utilities. I joined in April of 2013. Prior to INCA, I spent 5 years at Morningstar Equity Research covering the Latin American banks, Spanish banks, and a few U.S. banks. Before Morningstar, I earned an MBA at Stanford University, before which I was an investment banker at Citigroup, based in Mexico City, looking at deals all over Latin America. I was also a professor of mechanical engineering at the Universidad Iberoamericana, from where I have 2 engineering degrees. I am a CFA charter holder, and I was born and raised in Mexico City. In terms of the opportunity or the overarching thesis that we see in investing in Latin American banks, you're absolutely right, and you mentioned it earlier. Globally, banks are out of favor. And especially in the developed market world, banks are struggling with much tighter regulation and decreased profitability. But I think that the market is overly discounting Latin American banks and not giving them credit for their ability to continuously create shareholder value even under harsh conditions. As my colleague said before, we look for strong franchises, and banks are not the exception. In banks, we look for A, strong track record of profitability, and B, market leadership. In terms of profitability, to give you an idea, the weighted average real ROE of our portfolio is 11.5%. That is nearly twice as high as developed markets, where it's between 6 and 6.5%. And B, when we're talking about market leadership, and this speaks to our thesis of the potential that we see there, because we think that there's tremendous growth coming in the demand for banking services in Latin America. One way to look at that is if you look at loans as a percentage to GDP, in the markets where we invest, we have Mexico, 30%, Peru, 37%, Colombia, 47%, and Brazil, 54%. This compares to 150% or more in the developed market world. And when we look at consumer loans, we're talking between 3 and 5% of GDP compared to well over 20% in the developed market world. So we think that there's definitely some growth there. As per our process, we know these companies, we know these franchises, we monitor them constantly, and when there's a drop in price or a surge in price as well, we modify our exposure. Take, for example, our 2 largest banking positions. We have Itaú and Credicorp. Itaú is the largest privately controlled bank in Brazil. It has a spectacular track record, 20% real ROEs in over 20 years. That compares to 8% of the system average. So that tells you a lot about how management knows how to navigate difficult environments. And when we added to the positions more in earlier this year, the price had fallen by 32%. We were getting this bank, a premium franchise, at 5.8 times earnings. And this is a bank that should trade well above 12 times earnings. So that's when we increase our position. Credicorp is the leading financial institution in Peru. For reasons totally that had nothing to do with its earning power, in late 2015, the stock had dropped by 40%. This company has a track record of earning real ROEs of 17%. So we got the opportunity to build our position at a price that was super attractive, at 8.1 times earnings, when this bank traditionally should trade at around close to 15 times earnings. So in conclusion, it's the growth potential, but as I said, as you know, my friends have, my colleagues, have mentioned before, we look for very strong financial companies, very strong franchises, and a proven track record.
Thank you, Mac. I'd like to open it up to the audience. If you have any questions on any of the presentations, please.
Thank you. On Via Varejo, I'm curious about Mercado Libre as a competitor, or other online retailers.
So yeah, I mean, maybe to address the question of online in general, this is obviously something that we've looked at because of what's happening with Amazon and Best Buy, and this will happen in Brazil. I mean, electronic sales will move online.
Wes, why don't you just real quickly explain what Mercado Libre is so they understand the context of the question?
So Mercado Libre is actually like the eBay, more or less, of Latin America. They're Argentine based. They are the most profitable e-commerce business in Latin America. They're a fantastic growth business, and they're a marketplace as eBay is, right? So to kind of address e-commerce risk for Via Varejo, which I think is the question. This will happen. We think this will take a lot longer than the amount of time we think it'll take for our thesis to play out, which even if it takes 5 years, this e-commerce risk is a very long-term thing in Brazil. And the reason for that, and firstly, that industry, there is no Amazon in Brazil. There are a number of players. It's a much more fragmented market, and actually Via Varejo is one of the leading players with their Sinova business, and there's a few others. Via Varejo has the best infrastructure currently in place because they already can deliver basically anywhere within a few days, whereas anyone else, a pure e-commerce, has to really build out that infrastructure because there is no post office that can do that. So it is a fragmented market. Via Varejo is a player and can be a winner. The infrastructure for e-commerce is many, many years behind the US. And in addition, there's so many other issues along the lines of credit card penetration. For consumers to be able to buy online, they all need credit cards, right? And that's still way below the US. So although this is something that we're monitoring, I think just penetration of e-commerce in Brazil is currently so low. I mean, we're talking penetration, the US, maybe 50% of electronic sales are done online, and in Brazil, it's probably 15% or so. So we've got a long way to go before that, and we have a huge cyclical recovery potential for Via Varejo in their stores.
Mercado Libre is a company that we certainly know about, and it hits a couple of our indicators because it's not included in the index, and it's an Argentine-based company. But we have a certain problem with it, and that's called price. Now, let me, Dan, why don't you, Danielle, you covered that for us in the past. Why don't you real quickly tell us about the price of Mercado Libre?
Sure. So Mercado Libre is a company that, like Fernando mentioned, we really like. I mean, it's a company that we really like because the franchise value is there. They dominate the e-commerce market in what they do. They're the number one player by far. They grow in volumes. They're just very good at what they do. Management is very capable. They're very good too. Also, their liquid stocks is a company that we can really build a position in. So in terms of the company, we love it. We love Mercado Libre. But the problem is that, as Fernando mentioned, is the price. I mean, Mercado Libre is a company that trades an FP of 50 times, on record earnings, right? So it's a company that it's just tough to really buy into. Now you're buying into growth projections and whether those come true, and the margin for error there is not really there. There's no in terms of like when we're looking at, and if every company was on the same level, then okay, you go with Mercado Libre. But when you look at the opportunity set that we have available, and you see a company like Via Varejo trading below net cash, I mean, right? Like those are the real value opportunities. And at the end of the day, the portfolio, like in terms of our buying and selling decisions, like Fernando mentioned earlier, it's a matter of like what's the best, that we can hold, and if we can find something that in order for something to be added to the portfolio, it really needs to be a lot better than what we have in it right now. And for Mercado Libre, in terms of franchise value, is there. We're just halfway there. Now we need the price, the valuation.
Thank you. Any other questions? Yes, Ethan?
same company on Via Varejo, and sorry if I missed this, but are they issuing their own credit cards? You know, a lot of the Latin American retailers obviously are mini banks in essence, and I'm wondering
Yeah.
if they don't, is that an area they want to
They actually don't. What they have is they have a partnership with Bradesco, but where Bradesco, one of the biggest Brazilian banks, they take all of the risk. So they issue the credit card branded by them. Bradesco takes all the risk, and they pay a commission to Via Varejo for that. So they don't take on any of the risk there. Now, as I mentioned, they do also provide their own credit, not in the form of credit cards. And there they do bear the risk, but that's 13% of sales.
Okay, Adam?
Let's talk about some of the stuff you don't own. You touted your decision to exit Argentina at the end of last year, but a lot of that market's now rallied 50, 60, 70%, depending on what stocks. So how do you evaluate like a Macro versus Itaú Credit Corp or Super VL? How do those fit? Why haven't those made the cut?
Okay, so let's talk a little bit about the Argentine situation. We exited Argentina at the end of 2016 because Argentina had really, end of 2015, Argentina had gone up due to at that time, it was the imminent Macri victory. And so that's when we really sold out because the Argentine positions were the best ones in our portfolio, and we wanted to put that capital to use where we thought it could do better. Since that time, or let's talk about this year, which is basically when we sold out of Argentina. Argentina as a market has gone up about 16%. The Latin American index has gone up about 33%. So as a market, it's only done half of what Latin America has done. But you're right, there's some particular companies like the utility company that's gone up a bit more. So let's talk about specifics because again, we don't invest in Argentina, we will invest in an Argentina position. And you just talked about the banks, which I think is critical because we think that the banks that's the way we were invested, by the way, via the banks. So I'm going to turn that over actually to Maclovio and let him talk about Argentine banks.
Sure. So let me take you back a little bit to the process. And as before, you're right. You mentioned some of the best franchises in Argentina. These are the largest privately controlled banks, definitely focused on profitability. It's Banco Macro and Grupo Galicia, which have been on our portfolio before, and we exited. And as before, right, we know these companies. We constantly monitor them. And we started building our positions in mid-2014 up until early 2015. At that time, the banks were trading between 6.5 times earnings to 7.5 times earnings. And the upside potential compared to our other positions were close to 20% per year in real terms. The difference now is that, as Fernando mentioned, when we sold them, that upside potential had shrunk to close to depending on which one, between 5 and 8%. And now today, we still believe that there's a huge growth potential. Argentina has a penetration of 17%, so close to half of Mexico. And highest GDP per capita, $13,600 per person. That's the highest in the region. Recently, it went over Chile, which is close by. But you get a sense of how much potential there is for increase in banking solutions, in just credit penetration, right? But at this point, and you mentioned Itaú, for example, we're talking Itaú, it's trading at 10 times earnings. And Banco Macro or Galicia are trading between 12 and 12.5 times earnings. If we look at real ROEs, because now that's being a big burden on these banks, we're talking at Itaú is between 12 to 15% per year. And Banco Macro or Galicia is 3 to 5%, Banco Macro is 2 to 3%, right? So we definitely monitor them, we look at them very closely, but at this juncture, even though as we've said before, right, we don't invest for the country, we don't invest for the macro. We think that there is the opportunity there, but at this point, the valuation or the upside potential is not appealing enough to make us start a position there. But we certainly monitor them very closely.
Sorry, can I get a follow-up on
Yeah,
that?
sure.
So do you have no view on the tax amnesty being a big boon for the banks?
That's going to be a little bit harder for us to really put into the fundamental analysis of what how the banks can improve. Really, while that could be a factor, what is going to make banks, investing in banks, a good factor is what Maclovio talked about. Banks eventually have to lend money at a certain rate, and it has to be considerably below their cost of deposits. And that's where we see the opportunity is. And that means that what has to start happening is that interest rates have to come down, and interest rates are going to follow inflation. When that happens, then you're going to get some lower interest rates, and then you're going to see banks do what they should be doing, and that's lending money below their cost of capital, and that's how they're going to make eventual money. So that's a positive factor. But for us, that would not be a fundamental long-term factor. Cameron, did you have a? Okay. Anybody else? Yes.
Just on the financials, I'm curious. You look at PE. Why not look at price to book? Or do you have to think about adjustments for write-offs and stuff like that?
So no, we definitely look at price to books. The reason why we focus more on PEs is because it's part of our process. That's the way in which, after normalizing the earnings, we can get a sense of how much earnings power a bank has, and compare it across our investment opportunities, right? So, because it's not the same thing to talk about price to book in one sector and then in a different sector, right? But we definitely monitor that. We definitely use that as a reality check, if you will, because in banks, one of the reasons why price to book is so nice to use is because it gets you a clear idea on like where theoretically they should be trading based on the spread between their ROEs and their cost of equities. So we internally, when I look at the banks, I definitely look at them, and it's just, as I said, a reality check. If you look at Itaú, we're trading at 2.1 times or 2.1 times their price to book, whereas its theoretical value should be closer to 3, right, based on the spread that they make. So I look at it, but in order for us to kind of marry the whole process and look at across the whole spectrum and manage the portfolio, we focus on price to earnings.
Let me just complement that a little bit in terms of, again, some of the tools that we use in order to analyze the various different sectors, particularly for the bank matrix. We look at, not only do we look at price to book, ROEs, look at NPLs across, so the tools are there for us to be able to analyze multiple sectors. Just so my cement spreadsheet will look a little bit different than Maclovio's, but the aim is for us to eventually come to a common place where we're talking about all the investment opportunities across one discipline. Yet we use multiple tools to get there. So I just wanted to clarify that in terms of the various tools that we use and how we look at them sector by sector.
Any other questions?
Sorry,
Yes.
go ahead.
Yeah, I just want to ask about Brazilian banks. Can you just compare and contrast Itaú with Bradesco, because you owned both in the past, and yet Itaú is the one you've gone for before?
Sure. So you're right. We owned both in the past, but and again, it's the same. Going back to our process, when we look at the upside potential, this year Itaú has risen by 70%, whereas Bradesco has risen by about 82%. So the upside potential for Bradesco is shorter than for Itaú. That's reason number one. And then reason number two, Bradesco is in the midst of acquiring HSBC Brazil. While look, I know management. I think they're very straightforward, and in general terms, I believe what they're saying, but especially about the synergies and the branch closings and all that. However, it doesn't matter how conservative you do it, they will still have to undergo a significant adjustment process. And that is not another risk that we need to take in a Brazilian bank as of today. So it performed very well. The upside didn't merit having the two positions, so we decided to exit Bradesco because of the risks, especially with the HSBC acquisition, which it's not only on reduced profitability because they need to spend some more money, then might take about 2 percentage points off their ROE, but also the capital consumption. And this is a time where we definitely do not want to have, do not want to lose sleep based on low capital levels.
George, I would just add that I think, generally speaking, mergers are something we certainly are aware of. It's going to be happening more in the Latin American environment, but it is always a little bit of a yellow flag for us. And so anytime we see these mergers, we are a bit skeptical that, at least on the shorter, medium term, there could be a negative turn at first, and that actually may give us a buying opportunity into it. Ethan, did you have a question?
Trying to assess these are obviously look like some very attractive opportunities, but to think of it in context of how attractive is it, you give us a sense, you mentioned the weighted average PE today is about 13x portfolio. How does that look compared to a historical PE of your portfolio, and how does it look compared to a relative PE today versus the index on a historical basis? And I guess if you have the data, and you take all your sort of upside to target prices today and you weighted average those, how does that look? What's the upside on the portfolio today relative to what it was a year, 3, 5 years ago?
Okay, so first let me take it from an overall market view. Market information is very hard to rely on. Why? As I mentioned, one of our big and primary jobs is to get normalization of income statements, and that is the bottom line, the net income number. Most index information is not going to do that normalization. So what you get is they take straight numbers. If you look at the MSCI, they take the straight bottom line net income, and then they, based on that, they come up with PEs, which can be highly distortive, especially in a time of volatility like we've been seeing right now. Why? Because some of those earnings could be highly depressed, and you get actually very cheap companies trading at very high valuations. And so for us, market information like that has never been particularly useful to be able to tell where valuations are or pockets of value are. What we do, the way we find cheap valuations, is on a company-to-company basis and comparing it to industry standards or other industry peers. And that's when we can get a sense of attractive valuations. After we've done our own work on a particular sector, we compare it to its peer Latin American companies and also global competitors. And so when we do that, our normalization, and then we can come up with our portfolio one. You're right, we have that 13.2 times right now, and how does that compare to the past? Again, I do want to make a caveat to it. The difference is because we've had a strong decline in, as I mentioned, if you look at what net income did last year for our companies on a local basis, it was 8%. But you turn that over after the devaluation and you get negative double digits, somewhere in the teen numbers. So again, we're going to have some companies that are going to look like they're growth companies when they're really value companies, but they may have some metrics that make them look above average growth. So you have to take that into account. Having said that, if you do that, our lowest PEs that we are ever seeing in our portfolio were at about 10 times. And when did that happen? Actually didn't happen after the Great Recession. It happened in December and January of this year. And so yes, there's been an increase in those valuations. We would say that 13 times number is still at a very attractive level, and it's also overstated. And again, the technical side of the information would kind of confirm that there's good opportunity still out there. I think one of the things we'd like to say is that we're not quantitative people. So what that means is we don't come up with certain price targets or something else, and then we say, hey, that is going to dictate what we do. What we do is we take our experience and we say, look at these different points of information. Are they coming together to support what we're seeing of what we believe can happen going forward? And so it's not ever one metric. It has to be a combination of different metrics coming together that allows us to put our qualitative experience into that and allowing us to make an investment decision. So it's really a combination of factors that allow us to make decisions. Yes.
Your fund size is now around 600 million.
Right.
How different would your portfolio look if the fund would be 50% less or more, like 300 million or 1 billion? Different kind of portfolio in terms of number of companies, different companies?
So let me First of all, $600 million, you're absolutely right about that. It's not really the fund. Actually, most of our accounts are actually in separate accounts, and then we have only about 15% of the assets under management in a fund. Having said that, we manage them all pari passu. There's one exception, and that is we have some clients who don't have us invest in Brazil, so we merely take out the Brazil portion. So it's not really a different mandate, it's a sub-mandate. If we were, I think you would find a pretty close consistency of how we invest in the number of the metrics of the companies that we invest in. And that is over time from us. So we started with $100 million in assets under management, and then we've moved up now to $600 million. So I think we still have room to be able to grow there. But the important thing for us is value, and we find value in different places, and that the place of values change from time to time. And sometimes they're more maybe in that small cap sector, sometimes they're not. Sometimes they gravitate towards the larger cap names, and we aren't in charge of that, but we react to it. If you look at our metrics, generally speaking, you will always find about 50% of our portfolios in that small and mid-cap sector, and that's been fairly consistent over time. So I don't think, regardless of what the asset size was right now, that you would find that our portfolio would be different. But somewhere down the line, we do realize that if we take ourselves out of that small and particularly that mid-cap market, which is where we have the majority of our portfolio, then we would have a different portfolio. And that's when we have to really stop the assets under growth. Where is that? We think we could probably do twice as much as we do right now and still be able to tackle that most important part of the asset side of the market cap size, which is that mid-cap company. That's where the majority of it is. Small cap always gets difficult for us. So if you notice, Via Varejo, we love that company, but we're still somewhat limited to be able to get into that. And so what we did a little bit differently during this decline is when the liquidity went way down, we have to think about what's the liquidity going to look when we want to get out of it. It takes us a little bit longer to build it up, and we can only build it to kind of a minority position. So what we did is we added a few more positions, and so we created that opportunity for portfolio appreciation through the small cap by taking smaller positions, because normally speaking, we'd like to be in that 8 to 10% range for each position, but you can't do that with this small cap side of the equation. So again, where we have enough room to work with is really those mid-cap names, and those make the majority of our portfolio, and we want to make sure that we can always invest in that sector. Yes?
You've added some staff here over the last couple of years. We've been talking about assets under management. You've obviously had a relatively big increase in the number of people in the firm. How has that changed how maybe your role in particular, or the team operates versus prior bringing on 3 or 4 people in the last couple of years maybe?
Right. So when I mentioned when I founded INCA Investments in 2004, you would be looking at the team, me. But the primary reason I wanted to have an opportunity to really start INCA Investments is because I knew how much more we could do if I had help. And so that's what growing assets allowed us to do. By becoming independent growing assets, we were able to grow our assets, and then we were able to hire the talent that we needed. So the way that has changed is that as an organization, we realized it was about process. And so we've been working on the process so that it can be managed by people with an experience level in Latin America and all have the same mindset. So hopefully that's what we've been able to demonstrate here. I think you'll find that we have this value mindset that permeates our business, our company, and that we have a process to make sure that what we do is repeatable. That's very important to us.
So what about future staff growth? Do you see yourself, are there holes where you'd like to fill in particular, like different sectors or whatever, or how do you see that?
We think that the single most important decision that we make is not picking a stock, it's picking people. And so what we do is we continuously look for people. We let the headhunters know that we work with, that we're still interested in interviewing people. We let the sell side know. Sell side is a great, introduces a lot of people to us. And so we continue to interview people, not because I think we have a hole, but because we know how important it is to get someone in to add something to our team. So we don't feel a necessity that we have to hire someone right now. But if we see someone with the experience, the talent, and the fit with our organization, we certainly have room to bring them in. Yes, Hannah.
Ternium, that sort of stands out in your portfolio is not necessarily like a franchise type company that most of the rest of your portfolio is.
Well, I'm going to have Efrain talk about that because he covers the steel sector. And so let me just say that we do think it's a franchise company. Efrain will tell you why, but I think where it is different, it's a commodity play per se, where the price of the steel can affect the company. But if you looked at that, I didn't have the price of steel, but if you look at the price of steel right now, you see it's already gone down quite a bit. And so can it go down further? Yes, it can go down further, but we think that Ternium is a company that can certainly handle that. But let me turn it over to Efrain to talk about Ternium.
Sure. So thank you. Yeah. So, and just to put some numbers around the drop in steel prices, to put it into the context of the process, steel pricing had dropped from about $1,600 a ton to about $600 a ton when we started to see the stress that this had created across all steel companies, and Ternium was no exception. Now, having worked with Ternium for many years, even back to my days at Goldman and at Artha, I knew this company very well. I knew that their main customer was the manufacturing of autos in Mexico. That was the largest customer to them, and this is an area where they were going to grow. I also knew that the price had come down in terms of steel pricing quite a bit. But most importantly, when I look at the franchise and franchise value, if I was to put up a chart of the margins, the operating margins and returns that Ternium can post relative to any of its Latin American peers or North American peers, it really stands out. I'm talking, this is the only steel company in the Americas that did not post a loss during this, this downturn that you saw. Now, for us, this is something that really caught our attention, right? Given the drop that you had seen, and when the most telling point for us was when we looked at the free cash flow generation of this company. We were looking at a company that was generating north of 30% free cash flow yield. And for us, given we were not making any estimates about the steel pricing going back up, going back to some historical levels. We just like in many of the cases that we talked about, we were just looking for a stabilization. With that in mind, we thought that the 30% free cash flow was just something that, from a valuation point, that we could not pass up, given the strength of the franchise and what they were feeding into, which was basically manufacturing of autos in Mexico.
How does it have, I don't know the company, how does it have a franchise value over cheaper Chinese imports or Korean imports? What does it do that's different? And
Sure.
How does it sustain that?
Yeah, with steel is kind of interesting commodity of sorts, because there are many grades of steel, and you certainly had more value add as you go up and you get closer to the end customer. So when I say the main customer, it is the largest provider of steel to the auto plants in Mexico. Now, this is not a process that happens. You can't just get flat steel from China or Korea and just drop it into Mexico to manufacture. This is a lengthy, sometimes 2-year process that they have to go through in order to get certified to be able to provide the steel to these automakers. For automakers, just-in-time delivery and in terms of the process is critical. So the fact that they're in their backyard in Mexico, I mean, literally, I was there about 7 months ago, and their new expansion plan, which is feeding directly into this higher grade steel for autos, literally you can throw a stone from the Ternium plant to Kia's plant, which is just, I mean, I've never seen anything so large in terms of the manufacturing capabilities that are going on there. Again, the proximity, their ability in their ability to service their end customer with higher value products that need a long length time to actually get certified is really what gives them more of that franchise value, and they're able to generate. Now, they also have a cost advantage because they took a longer term view when many steel companies were just developing blast furnaces where they were just dumping iron ore and coal. They went to a higher end technology, which is DRI, which basically uses natural gas and electricity to make steel. This has given them a very large advantage in terms of cost. So all these things together really develop the franchise and their ability to generate higher profits.